I wanted to highlight the value proposition of insurance products just from a quick numerical example, because both financial advisors and insurance products use bonds as the underlying, retirement strategy. So if you're a financial advisor, they'll slowly move you over from stocks to bonds as you get older and into retirement. That's because bonds are safer. And same thing with insurance products. They use bonds to provide all these guarantees that you're. So both are using bonds. It's just one is a lot more efficient than the other, because if you invest in bonds with an advisor, you have two things. You're paying high taxes because bond dividend yields are very highly taxable. That's all ordinary income tax. On top of that, you're paying a large ongoing advisory fee for the life as long as you live. So that's the downside. And I just want to do a quick numerical example of use investing in bonds via an insurance advisor versus an insurance product, right? So in both cases, here's the advisor strategy. Let's just assume the gross expected return is 5% for both, right? That's a gross return. If you invest with an advisor, you're getting 5% on your bonds. Unfortunately, if you're investing with an advisor in bonds, that's all. Most of that's going to be taxable bonds, right? So that's this marginal tax rate. This is the top, federal tax rate, more or less. Or federal and state. Let's say federal and state tax rate. We'll talk about how in certain states with higher incomes it's actually higher than this. But we're going to assume 40% for federal and state. So of this 5%, if you're using an advisor, you're losing 40% off the top. So I'm down 2, right? So that gives me a net of 3. After taxes, I'm at a net 3. But then I got to pay the advisor his or her ongoing fee, right? So that's minus 1%, right? So now I'm losing that. I'm not paying any insurance expenses, which is good, right? But so on that 3%, I subtract the 1, I'm at 2. So on a 5% gross return, right, I as the client am getting about 2%, which is more or less, keeping up with the cost of inflation, right? But I'm losing 60% of the return, right, to taxes and fees. And people aren't kind of realizing this. If the advisor is just going to put you in bonds, like this is the effect, right? This is the ongoing drag. And, we'll talk again in another video about like this is a large fee relative to your after-tax return for something fairly safe, right? So now bonds within an insurance strategy, again, same 5%. You're not paying taxes on the bonds, right? There's no return loss to taxes. So you still gross return is 5%. You're not paying an advisor fee, but you are paying insurance expenses. And let's say those insurance expenses are about 1%. So you're getting about 4%, about 4% after taxes on the bonds strategy. So if you're investing in bonds, you're doubling the returns, right? So high net worth clients are doubling their bond returns by using an insurance product to invest in bonds instead of an advisor. Again, I'll go into this more detail in another video, but just understand like this is the value proposition, is that insurance products are providing a vehicle to invest in bonds that are more tax efficient and have less fee drag over the lifetime of your retirement than a traditional financial advisor, right?